Good afternoon, everyone. Thank you for joining us for our webinar today. I'm Amy Rizzo. I'm the marketing manager here at Kelleher and Holland, and our topic today is regarding phantom equity plans and how they can attract, incentivize, and maintain key employees. And that's a phrase you'll probably hear a few times during this presentation. So before we get started, if you have a question at any time during the webinar, please type it in the Q&A box that is located in your Zoom control panel, and we will address them at the end of today's presentation. So our panelists today provide a diverse array of practice area experience. Andy Kelleher is one of the founding members of Kelleher and Holland. His legal practice concentrations include business and trust and estate law for high net worth clients, including trust and will planning, corporate governance, mergers and acquisitions, taxation, exit and succession planning, and asset protection. Keith Sermon is our co-chair of our corporate group, and he focuses his business on real estate and business transactions, including mergers, acquisitions, sales, and both equity and debt financing. He also advises clients regarding entity formation and structure, contract negotiations, as well as day-to-day legal business matters. Madeline Kelleher is part of our employment law group and handles a variety of matters, including executive contracts and compensation, hiring and terminating employees, restrictive covenants and trade secret protection, defense of employment claims, and general employment counseling. So, okay, Andy, I will turn it over to you to tell us why we're here today.
Thanks, Amy, and thanks to everybody who's attending today. We appreciate you taking some time out of your day to learn a little bit and have a little bit of a fun discussion. So today's discussion, just want to make it clear, it's for educational purposes only. And it's not for legal advice. We always have to do that disclaimer because we're attorneys. We like disclaimers and things like that. So we have today's topic is phantom equity. And phantom equity many times is a missing incentive in key employee compensation packages. And we see this missing link or missing incentive piece, right? Especially in smaller, closely held businesses. According to studies, a lot of smaller businesses are incentivizing people more on a short term, whether or not it's variable or fixed compensation. And they don't really focus on how to compensate or reward, I should say, key employees that they want to be with the company for a long period of time. And also, in addition to phantom equity, which we're discussing today, I just want to make a point of it that in business situations, it's life insurance planning, whether it's an ingredient of employment compensation or whether or not it's an ingredient in a shareholder or buy-sell agreement. It's a woefully missing component. And there's a bit of an epidemic we see in our practice of there just not being enough life insurance, protecting companies and their employees. Just want to mention that. So back to the phantom equity plans. They're just a phantom equity plan. It's just one of many, qualified and non-qualified long-term incentive options, right? So there's plenty of other topics that we can discuss at a later date, but today we're going to be just focusing on the phantom equity. But that being said, compared to the other options, a phantom equity plan tends to be much less complicated than the other options for purposes of, let's say, ERISA or taxation. It ends up being a pretty efficient and effective option. And once clients understand what it is, they tend to really like it. So phantom equity plans applies to most companies out there, right? We normally see it in the closely held companies. And one thing I just want to mention, when I mention companies, it applies to corporations, LLCs, partnerships, and the like. But as an aside, I just want to make sure that professionals and other people with special licensing need to be really mindful of those licensing when they're taking a look at any type of compensation, family equity plan or other compensation. Just be very mindful of your licensing. Also, phantom equity plans, they come in many shapes and sizes, right? They can be used broadly, narrowly. And there isn't a formal or statutory definition of the term phantom equity plan. It's otherwise known as maybe phantom stock plans. Maybe people have heard of that, or synthetic equity plans. But generally speaking, phantom equity plans, because they apply to corporations, LLCs, and the like, we don't use phantom stock because that's only a corporate term. But like I said, the phantom equity plan applies to many different types of organizations. And another important assumption in our discussion, just rounding things out here, is that it's the intention of the business owners that their business is actually going to grow in value, meaning the business equity is actually going to grow because a key component of the phantom equity plan, and when you're dealing with key employees, is there's actually going to be growth. So I just want to make sure that assumption is stated. Okay. So what we see in most businesses is that they provide their employees with typical, short-term variable and fixed incentives, right? Those would include like salaries, discretional annual bonuses, commissions, and the like, retirement plans such as 401k plans and other plans, and then other typical employee benefits such as health insurance, right? And many situations, that's fine for a lot of employees. And they're very happy with that. And so are the business owners. But there's many situations where ownership and key employees, they want something more. They want something more to solidify their relationship and align their interests. And that more many times means longer term incentives, right, towards the employee, sharing a piece of the pie, whether through the employee just sharing in the growth of the company or the piece of the pie, right? Over the course of time, based on the company's overall efforts, or maybe even on that employee's isolated efforts. So, but the bottom line of it was the employee wants more. They want that little piece of that pie there to be included. So, who are key employees, right? I tried to come up with a good definition for everybody here. So, my definition was a key employee is an indispensable teammate, helping to drive profits, growth, stability, and culture, all leading to higher equity value. And I think that's a pretty good definition. Anybody has other ideas? I'd love to hear it. Key employees are teammates who work for, the business and not the paycheck, right? We all know those type of employees. They really are dedicated to the business and not just looking out for themselves and not just looking, for that paycheck. And they tend to be the long-term loyal people. I think that many of us that can identify in our organizations or the people that we work with. Key employees can include what? They can include management folks. It can include, CFOs, the chief financial officer. It can include chief, operation officers, even chief executive officers, CEOs. Many times you'll have a closely held business where ownership is passive. So this can absolutely apply to CEOs, and also applies to production and sales teammates, field managers, salespersons, floor managers, and the like. Again, those teammates who are driving profits, right, growth, stability, and culture. Anybody that does that, is going to, is what many circumstances a key employee. And then I like to say in a lot of small privately held companies that we came up with our own term called the COO, meaning the person who does the functions of all the functions, right? So the idea is we run into a lot of situations where, businesses have that person who does one or more of all the management and production functions. Going back to the basic goals, right? There's generally two parties involved, right? There's the business owners themselves. And on the other hand, there's the key employees. Business owners, what do they want? They want to do a couple of things. They want to attract, incentivize, right, and maintain key employees, right? They want the employee to start thinking and working like an owner. Another way of putting it, they want to align the interests so that the key employee and the business owners are on the proverbial same side of the table, right? That alignment's important. The business owner wants to be competitive, right, with other company offerings. As studies have shown, smaller, closely held businesses do not incentivize their employees on a long-term basis when compared to larger companies. And so for smaller companies to stay competitive, to maintain that really important person, giving that long-term incentive is something to consider. On the employee side, as I mentioned earlier, right, they want to participate in the value, or the growth of the company. They want that piece of the pie in addition to their salary and the other compensation components that I mentioned earlier. So that kind of gives you the the drivers or the goals of each of the business owner and the key employee. So what are the intended win-win situations, right, for both the business owners and the employees? And I say intended because the first one is an interesting one, and that's to incentivize a lot of key employees, business owners, right? They say to themselves, I know how to get the key employee to think like an owner. I'm just going to give them stock, and it's really easy, right? Well, giving away, stock or giving away equity in the company, right, is a perceived simple path that can lead into a lot of unforeseen and make consequences that can leave business owners really unhappy, right? So what I mean by this is when you're actually, this means when a business owner actually gives equity, meaning stock, right? LLC, participating units, or partnership interests directly to the key employee, where the key employer is actually an owner, right? So we see owners act so fast and many times just giving away, a percentage of the stock, and they don't take the time to really go through all the ups and downs, of a major balance sheet topic, right? And from our perspective, that can be, frustrating because owners, should be seeking legal counsel ahead of time and properly gauging, right, the consequences of giving, ownership away. So some of the downsides, right, or consequences of, giving equity away are lost flexibility. Many times when you give away the equity, it's gone. It's like the bullet came out of the gun. It's hard to retrieve it. We have situations, especially in startups, where people have given, key employees or even potential partners, right, too much, and the person who's the driver of the value, usually the business owner, has remorse, for giving away so much. And then we see, in many, many cases, right, when key employees end up with equity, they have certain rights that the business owners may not like. So, for example, privacy, business owners can lose privacy, where the key employee would have the right to inspect the books. Many owners and employers don't want people seeing the books. And then most of all, we see the employee ending up with powerful statutory and common law rights, right? And that lead to minority, shareholder disputes, employment complications, and derivative lawsuits that we handle on a regular basis. We experienced all this, firsthand because the Kelleher and Holland Corporate Group and litigation practice groups handles these type of cases on a regular basis, and we're trying to give our clients and the public maybe a different way. So what is a better win-win solution for the business owner and the key employee? It's to incentivize, right, the key employees to think and work like an owner, to lessen the downsides of granting equity, and give the employee what they want, to give them a piece of the pie. And today's topic, surprise, the answer is, phantom equity plan. A phantom equity plan is a long-term deferred bonus plan. That's probably the best way of summarizing what a phantom equity plan is. Okay. It allows key employees to participate in the value and growth of the company, very importantly, by not diluting the business owner's equity. That's a big deal, right? So the employee gets what they want, and the employer doesn't have doesn't have that dilution in their equity, and the employer also avoids many of the legal downsides of granting the equity. So the phantom equity plan play is a true win-win. Again, just to kind of give a little bit more context and flavor to what a phantom stock or phantom equity plan is. As we said earlier, it comes in many shapes and sizes, right? But most of the time we see the phantom equity plans mirrors things like, restricted equity awards, of actual equity, stock option type plans. And probably the most often that we see in our practice, I think Keith would agree with this and Madeline would agree, is the phantom equity plan would grant key employees participation rights, right, to participate in the proceeds from an eventual sale of the company. So again, with the phantom stock plans or phantom equity plans that we put together, I just want to reemphasize that life insurance is a component of those plans that shouldn't be overlooked. And that's something that we see mistakes made all the time. And again, in summary, a phantom equity plan, is an excellent solution to attract, and incentivize and maintain employees that should be considered by business owners before they grant equity. and in many cases before they even consider other long-term incentive plans. And we've had a lot of success with these phantom equity plans. Clients are incredibly happy. So, with that, I'll turn the presentation over to Keith Zerman and Madeline. And again, I want to thank everybody for taking the time and coming out today.
Thank you, Andy. That was a great overview. But let's get into the nuts and bolts of what a phantom equity plan is. So, Madeline, can you elaborate a little bit?
Absolutely. So, as Andy just mentioned, a phantom equity plan is a type of non-qualified deferred employee compensation plan that gives selected key employees many benefits of equity ownership without actually giving them company equity, hence the term phantom. Equity plans work by awarding a participant with phantom equity pursuant to a contractual agreement between the phantom equity plan participant and the employer, so that the right of ownership in the company's phantom equity is purely a contractual right rather than an equity right. So phantom equity plans typically involve a few key components, as you'll see on your screen on the PowerPoint right now. So first, an actual award of phantom equity units, which can also be calculated as a percentage. The specific number of phantom equity units, or the percentage of phantom equity, awarded to the employee may vary depending on factors like seniority and performance. Next, there's a key component is a vesting schedule that provides the employee does not get all of the shares at once and must continue to work at the company to earn the full value and amount of the phantom equity awarded. There's a payout structure, which is usually made in cash, but can vary as to when and how the value of the phantom equity will be paid out. And then finally, we have triggering events that trigger the cash payout to the participant upon the occurrence of one or more certain events. Some examples of triggering events can be the sale of substantially all of the assets of the company, the sale of the company itself, or a change in control of ownership of the company. As Andy explained, the overall idea is to promote the employee to think like an owner in terms of doing what he or she can to help grow the company without giving the employee ownership rights. Instead, the company is merely giving the employee the right to share in the growth and success of the company, the benefits of which the employee later realizes or reaps upon a triggering event.
Great. Thanks, Madeline. So, Keith, why might a company want to issue phantom equity instead of actual equity?
Well, as Andy and both Andy and Madeline alluded to, there are pluses and minuses to the owner if you would how you incentivize or how you attract talent. One is the equity, and as Andy mentioned, we don't want to give equity because of a variety of reasons. Number one, as Andy mentioned, the dilution of the shareholders. Number two, the shareholder or the phantom or the equity recipient has rights. He can look at the books and records of the company. They can also involve disputes. Andy alluded to it, minority oppression suits, which is a state right that minority owners can bring claims against the company and even management for things that they feel they are being oppressed by. Because they're a small owner, that they're not being treated fairly. Phantom equity gets rid of that because it's strictly a contractual relationship. There's a contract between the company and the employee explaining those rights in it, and I'll get into that a little later as to how it works. So the flexibility is also a huge component. I can structure a phantom equity plan and make awards different for each separate participant. If Andy and Madeline were my employees, I can say to Andy, you've done a great job. I'm going to give you 1%, and it's going to be 50% vested right away, and the remainder will be vested over 5 years. Madeline, you're new. You're going to vest over 10 years. So I've got that flexibility to award different people different rights or equity rights at the back end. And Andy alluded to this. We're talking today about a very simple probably the most basic and common phantom equity plan, and that is where when the company is sold, the participant gets a percentage or a percentage of the units on the sale. For example, and we'll get to some examples later, but if Andy's a 1% owner and we sell the company for $1 million, he gets 1% off the top. It's a very nice incentive that tells the employee, hey, I want to stay here to be for the big payout because I've worked for that. I'm getting paid my salary because that's what I'm worth. But now I'm getting some worth in the company that I've helped build. And that's really the incentive. In addition to incentivizing employees, we want to attract good employees. Smaller businesses have a tough job. They can't compete salary wise a lot of times. What can they give someone? Hey, you stick around, help us grow. We're going to give you something at the back end. So their growth or what they receive is directly tied to the growth of the company. And that is made up in part of their efforts towards the company, not just coming in, collecting their paycheck and leaving at 5 o'clock. There are triggers, which Madeline mentioned. Those triggers are when does the participant reap those benefits? And we're simply going to say today, we're going to focus on the sale of the company. We're going to give them a percent of the proceeds, of the net proceeds of the sale of the company. There are other triggering events like death or leaving the company, retirement. That's much more complicated. As Andy said, it comes in all shapes and sizes. We're not going to get into those shapes and sizes today, but we're going to reward the employee or the participant with a percentage of the proceeds. So they feel that they had a real stake in building up this company. And that's what you want. You want your employees and your participants to act like owners when it comes to the equity or the payout at the back end. They'll put in more effort. It'll mean more to them as opposed to just getting their check.
And Keith, I just want to add, like for many business owners that we've counseled, and Keith, Madeline, and I work on a daily basis, but the idea is over time, there's different organizations where people have joined to work with other businesses to grow, the value of their businesses. And when business owners do consider and implement, different incentive programs, one being a phantom equity plan, over the course of time, to Keith's point, when people start acting and thinking and working like owners, the overall value of the business increases. And at the end of the day, everybody has more. The business owner has more, and the key employees have more. So these type of plans, if people can be a little bit more long-term thinking, can be a win-win for everybody.
One advantage, and we'll talk a little bit more about some of the tax. We're not going to delve into a lot of the weeds on taxes, but the income, when the payout is made, the participant then recognizes income as ordinary income, so that you are subject to the same withholdings, including FICA, as opposed to capital gain. If they owned equity and they would trade in their equity, there would be capital gain. The downside to the employers, it's ordinary income, but it is something more than they were getting before they were a participant in the plan. And the company, on the same token, gets to deduct that. Another advantage I see is you don't have to do a lot of revising of documentation. For example, I don't have to prepare or revise my shareholder agreement or my operating agreement. I can mention the phantom equity, but the participants are not parties to that. So we don't have to name or revise anything. It's just simpler.
So Keith, you alluded earlier to some examples. Do you want to go through a couple of examples on how this actually would work with a little bit of math?
Sure. For those who are not afraid of math, as the example says, employee A is granted a 1% phantom equity right in the company, which vests at 10% per year. Employee A remains employed, meaning he stays there the 10 years, and the company is sold. That sale is the trigger event. There are many trigger events. Like I said, you could have the sale of the company. You can have certain metrics, such as once you reach a certain growth level, it's that flexible. And as Andy said, it comes in all shapes and sizes. It's really what does the employer want and what does the employer think the employee would value. So in scenario one, employee A works for the company for 10 years. He's vested 100%. The company sold for $1 million. So he gets 1% of that $1 million. I'm assuming the million's the net. He gets 1%, which would be $10,000. Scenario two is he's only been there for 6 years. So he's only 60% vested. Company sold for $1 million. And upon the sale, the employee gets $6,000. That's $6,000 of ordinary income. It would show up on a W-2.
So Madeline, what are some things that a company should consider when designing a phantom equity plan?
As Keith and Andy and I have explained, there's a variety of ways that you can set up a phantom equity plan. There's no one great solution. You can choose if the employee leaves then he or she loses the right to that phantom equity. Or things that overall a company should really address is the objectives of the plan, the behavior or performance levels that the company is trying to incentivize, who will be allowed to participate, and thinking about both current and future positions in that regard. What percentage of the company value will be dedicated for this plan? Another one would be which type of phantom equity plan to implement. Are you going to implement a plan like those we've discussed today where participants receive just the full base value? Are you going to go into more detail and have kind of an appreciation where the participant would only participate in the growth of the company rather than just the base value of what that unit of phantom equity is worth? And then you can have to consider the frequency of units granted to participants, when the phantom equity units will vest, and special vesting rules for certain circumstances, how the phantom equity units will be valued, kind of mentioned a little bit earlier, and then when the phantom equity units will be paid out and how they'll be paid out. Those are kind of the overall things that companies should consider.
Because this is a non-qualified plan, there is a section in the Internal Revenue Code 409A, which I am not going to go into because if we did today, you'd be sitting here eating dinner with me. But it basically, you have to comply with these rules or there are some very strict penalties. The biggest one being that the employee is subject to a 20% excise tax. So what we've described today would be outside the 409A requirements of getting valuations and things like that. We're granting strictly a percentage of the sales proceeds.
Right. So because of the flexibility of the plans, that many of the plans could end up triggering this section 409A and all of the requirements within that section. And therefore, you really want to make sure that your plan is vetted out by an attorney with all the plan details specified in writing, so you can really make sure that you're legally compliant.
We were saying how it's a much simpler way to incentivize and attract talent and maintain that talent. There's really only two documents required. One is you set up the plan. The company will set a plan saying we are setting up a phantom equity plan. We're going to allocate X percent or something to this plan. And then there are the separate award agreements between the participant employee and the employer. And that's where you can have the flexibility saying, Mr. A provides more value. He knocks it out of the park. He's a sales rep and he's just killing it. So we're going to let him vest quicker, or we're going to give him a higher percentage. It doesn't have to be equal upon everybody.
Importantly, at the end of the day, if the business owner has people that are indispensable, right, that are driving profits, growth, right, value and culture, and they want to keep that person, the phantom equity plan, when compared to the other options to achieve that goal, is usually the most efficient and effective way of attaining that goal. And with some of the complexities that Keith and Madeline are mentioning about 409A and the like, like we can bypass a lot of that depending on how complex or the type of plan that is palatable or desirable by the business owners and the employee. So we do have that option for simplicity. And when you compare the Phantom Equity Plan to what we see on too often, and it many times after the fact, are some of the business owners promising stock or other equity to the employees. Be very careful what you say to the employee, right? We want to make sure that we manage proper expectations with employees. Or after the fact, we learn that the business owner has actually granted actual equity to that employee. And then when we see the dark side or the consequences and downsides of giving away the equity, the Phantom, any small amount of complexity or upfront work that needs to be done, well, that small amount of work will pale in comparison to the woes that business owners go through with minority oppression lawsuits, the complications with employees, and those derivative lawsuits. So the Phantom Equity Plan is something, if they want to keep people around, those key employees, want to, attract, incentivize, and maintain those employees, it's something to consider. And also, just so folks know, KH has a employment law group as well as the litigation practice group, estate planning group, and the corporate practice group. The employment group will often work with the corporate group and putting together employment packages for owners and employees. And the Phantom Equity Plan is the component of one of those. So just want to let everybody know that the KH Employment Law Group is robust and it has a great offering. So with that, Amy, I think I'll close it out if you don't mind. I just want to say thank you to everybody attending today. It was a pleasure, presenting to you, and I hope you learned a little something. Please feel free to give any one or more of us a call, and we're here to help. Thank you.